Now speaking, David Collins, Corporate Controller. Lennar Corporation's quarterly earnings call discuss the company's business prospects, financial condition, results of operations, cash flows, strategies, and prospects. The statements made during the call are forward-looking, meaning they give estimates on current date and do not guarantee future results. There are various factors that could affect future results and cause them to differ materially from those currently anticipated. These factors include those described in Lennar's earnings release and SEC filings, which cover topics such as risk factors, contained in Lennar's most recent 10-K filing with the SEC. Lennar does not assume any obligation to update any forward-looking statements. Now speaking, Stuart Miller, Executive Chairman. We have been successful in keeping our inventory turns on a steady path of improvement for the past 2 years. This requires inventory to remain tight, and we accomplish this by reducing and controlling our standing spec and model count. We've now reduced our standing specs to 4,715 units, down from 5,161 last year at this time, and our model count has decreased to 249 models versus 275 last year at this time. Our sixth playbook strategy was to maintain balance sheet strength so that we can buy land when others cannot. We have maintained a strong balance sheet with low levels of debt, no preferreds and no synthetic leases, all of which provides us with considerable flexibility during times of volatility. And finally, our seventh playbook strategy is to continue to drive our return on assets to provide the highest possible return to shareholders. In the second quarter, our ROA improved to 9.1%, up from 8.3% last quarter. We believe that our ROA should improve further as volume, margins, cash flow, cycle time, and inventory turnover all improve over the coming quarters. So in conclusion, I'm very pleased with our second quarter results and pleased to report that we achieved or exceeded our expectations for every major line item on our income statement. We continue to execute on our strategies that were crafted in the wake of an elevated rate environment, and that execution drove our success in the second quarter, and we are confident that these strategies will drive our continued success in the future. Lennar Corp's second quarter results demonstrate the company's successful execution of strategies designed to respond to higher interest rates. Sales team efforts, combined with digital marketing and dynamic pricing, enabled Lennar to produce 17,885 new orders, exceeding last year's volume by 1%. Additionally, home deliveries increased 3% to 17,074, and cancellations dropped to 13.5%. Net average sales prices stabilized around $450,000, dropping from a peak of $500,000 in 2022, and rental rates moderated due to rising apartment inventory. Margins bottomed in the first quarter at 21.2% but have since improved to 22.5%, with expectations for further improvement in the third quarter, 23.5% to 24%. The Lennar team continues to focus on production, inventory turn, cash flow, and return on capital, and expects to deliver 68,000 to 70,000 homes this year with strong margins and cash flow. Efforts to reduce costs and right-size margins with trade partners have yielded positive results, and cycle time has improved from 219 days last quarter to 215. Additionally, Lennar has reduced its land held on balance sheet to 70% controlled and 30% owned while maintaining tight inventory control and a strong balance sheet. As a result, ROA improved to 9.1%, up from 8.3% last quarter. Now speaking, Rick Beckwith, Co-President and Co-Chief Executive Officer. The housing market continues to normalize and recover due to increasing comfort with higher mortgage rates and tight inventory levels. Lennar has taken a price-to-market strategy to maximize starts and sales, increase market share, generate cash flow, and keep its home-building machine going. This strategy is reflected in the company's second quarter results, which saw new sales orders increase 1% from the prior year and 26% from the first quarter. The new sales pace per community averaged 4.8 for the quarter, down 4%, while new sales prices decreased 11% from the prior year but were up 1% from the first quarter. Cancellation rate was 13.5% during the quarter, a significant improvement from the first quarter. In the first few weeks of June, sales activity and cancellation rates have been consistent with the second quarter. 14 markets are performing well, including Southwest Florida, Southeast Florida, Tampa, Palm Atlantic, New Jersey, the Philly metro area, Charleston, Raleigh, Charlotte, Raleigh, and Coastal Carolina, Indianapolis, Dallas, and Houston, Phoenix, and San Diego. Other markets require higher pricing adjustments and incentives to maintain target sales. The land-light strategy has enabled Lennar to purchase finished home sites from various sources just in time for its production needs, resulting in an ending year's own supply of home sites improving to 1.7 years and controlled home site percentage increasing to 70%. Community count is expected to increase in the high single digits by the end of fiscal 2023. Now speaking, John Jaffe, Co-President and Co-Chief Executive Officer. Lennar's strategy of pricing homes to market and maintaining a steady pace of starts and sales has enabled the company to reduce direct construction costs, resulting in improved gross margins. In the second quarter, Lennar started 5.3 homes and sold 4.8 homes per community and finished with approximately 1 inventory home per community. This process allowed them to avoid building up excess finished inventory. Lennar's strategy of keeping starts steady has made them the builder of choice for trades, with many partners representing over 70% of their business. Construction costs fell 3% sequentially from Q1, and 8% year-over-year, which is lower than the 13% year-over-year increase experienced in Q1. For the first half of 2023, industry-wide start levels were down 100% compared to Lennar's 30%. Q3 and Q4 starts are expected to be above 2022 levels. A dedicated team has been created as part of the National Supply Chain Group to focus on value engineering and cost reductions, and will also focus on initiatives that will impact results in 2024 and beyond. Supply chain disruptions were minimal in Q2 due to steep declines in industry-wide starts, increased manufacturers' capacities, and Lennar's own strategies and communication. Cycle time decreased by 4 days sequentially from Q1, and greater reductions are expected in the back half of the year, allowing for increased guidance and deliveries for 2023. Even flow production has seen meaningful progress, and cash tied up in inventory is expected to be freed up in the coming quarters. Now speaking, Diane Bessette, Chief Financial Officer. This quarter, Lennar reported strong financial results. Operating earnings from financial services were $112 million, driven by higher profit per loan due to higher secondary margins, and a decrease in cost per transaction due to technology efficiencies. The drumbeat at Lennar to focus on returns on invested capital and cash flow continued, and the result was $4 billion of cash and no borrowings on their $2.6 billion revolving credit facility. Inventory levels were managed well, with 19,700 homes started and 37,300 total homes in inventory, including 1,300 completed, unsold homes. Additionally, the team strengthened the balance sheet by repurchasing $158 million aggregate principal amount of senior notes due in fiscal 2024, and repurchasing 2 million shares totaling $208 million, as well as paying $110 million in dividends. Shareholders' equity increased to $25 billion, book value per share increased to $87, return on inventory was 28%, and return on equity was 18%. For the third quarter, Lennar expects new orders to be in the range of 18,000 to 19,000 homes, deliveries to be 17,750 to 18,250, average sales price to be consistent, gross margin to be 23.5% to 24%, SG&A to be 6.7% to 6.8%, combined home building joint venture, land sales, and other categories earnings to be $25 million, financial services earnings to be $100 million to $105 million, a loss of $10 million from multifamily business, a loss of $20 million from Lennar other category, corporate G&A to be 1.4% to 1.5%, and charitable foundation contributions to be based on $1,000 per home delivered. This should produce an EPS range of approximately $3.35 to $3.60 per share for the third quarter. Seaport Research Partners analyst Ken Zener inquired, "What do you consider the most efficient long-term start pace for inventory turns relative to the 5.3 pace set in 2Q?" Stuart Miller replied, "Ken, our even flow strategy is an approach that focuses on developing strong relationships with trade partners to become more efficient. Our Start Pace program is a concept we use to identify performing and underperforming communities in order to optimize sales and closings. We use data-driven feedback loops to generate meaningful results across all 40 divisions and 40 geographies." John Jaffe replied, "We take a market-by-market approach to ensure our sales pace and start pace are in sync with local demand, land availability, and labor availability. This allows us to adjust our strategy for each community accordingly." Stuart Miller replied, "Let me just say that we are actively managing our operations to ensure success, with every other day meetings and feedback loops that include both data and interpersonal elements. This helps us stay informed and." Seaport Research Partners analyst Ken Zener inquired, "What is the goalpost for FY24 in terms of owned lots and implied cash flows in your even flow framework?" Rick Beckwith replied, "We remain focused on our asset-light balance sheet and improving the percentage of controlled home sites. We have excellent relationships with our land partners and land banks that are enabling us to make headway in this area. Our target for 2024 is still being determined." Diane Bessette replied, "Our long-term goal is to ensure our net income equals our cash flow. We're not there yet, but we are making progress in becoming less asset-dependent and reducing our years owned." Stuart Miller replied, "I'm confident that we are well on our way to becoming an asset-light model. We have set out our goals and taken significant steps to reach them. We monitor our progress closely and make sure that our processes and relationships support our mission. While I can't provide specific details or timeframes, you can anticipate ongoing improvements in this area." Goldman Sachs analyst Susan McClary inquired, what lessons have you learned to maintain inventory returns and cash generation with the expected increase in pace? John Jaffe replied, Susan, the supply chain disruptions are largely behind us. Our size and scale has worked in our favor with manufacturers running at full capacity. We've learned how to work with them differently, providing more visibility into what's coming and creating local distribution to reduce lead times. This intense focus on the future should lead to improved results in 24 and beyond. Stuart Miller replied, I believe Rick and John have been working with our suppliers to identify ways we can avoid potential supply chain issues in the future. There is still work in progress, so we cannot provide specifics yet, but it is a priority for us. Goldman Sachs analyst Susan McClary inquired, what are your plans for allocating the cash generated from operations, specifically regarding shareholder return? Stuart Miller replied, great question. We're very focused on cash flow generation and capital allocation. Cash flow is accumulating at a rate which exceeds our current position, setting up potential opportunities. We are taking an opportunistic view of stock buyback, and we're also looking at other strategic possibilities that will be revealed in the future. We recognize that our cash accumulation is greater than the industry standard, and we're being thoughtful about how to best use it. Evercore IC analyst Stephen Kim inquired, what opportunities are you seeing to grow market share through regional bank stress, and can your existing off-balance sheet structures accommodate them? Stuart Miller replied, the land development sector is feeling the effects of current market conditions. As for home building capital, it remains abundant. We are working on off-balance sheet solutions such as OpCo/PropCo type structures to address current dysfunction in the market. We have the financial resources to explore and take advantage of opportunities that support production trajectory and consistency. All of these initiatives are focused on growing our core business of building homes. Evercore IC analyst Stephen Kim inquired, what impact has the shift in product mix had on absorption rates since the post-pandemic period? Rick Beckwith replied, the pace of our starts for Q3 is a direct result of the strategy we've implemented. John, Stuart, and I have collaborated with regional and division teams to develop a community-by-community start plan that allows us to maximize our production. We are taking advantage of some lower entry-level communities in certain markets, but, ultimately, it comes down to disciplined management of our start program. That's why we can confidently provide visibility on our progress going forward. John Jaffe replied, Steve, as Rick mentioned, we're focused on ensuring our sales align with our start rate to avoid any unnecessary inventory buildup. We're leveraging lower price points in markets like Texas to increase our sales pace quarter by quarter. Wolfe Research analyst Truman Patterson inquired, can you explain the drivers of the atypical increase in orders that you forecasted for the third quarter? John Jaffe replied, Truman, we saw a great opportunity to capitalize on the decreased market inventory in Q2. We accelerated our starts to take advantage of this, and our strategy of limited inventory buildup gave us confidence that we would be able to sell quickly with healthy demand for housing. This allowed us to maintain an aggressive sales pace matching our start pace. Wolfe Research analyst Truman Patterson inquired, would cost savings sequentially continue into the fourth quarter, and would pricing benefit on an apples-to-apples basis also flow through? Stuart Miller replied, we are not making any definitive statements on our fourth quarter margin, as the market still has some proving to do. As of now, we expect margins to continue improving throughout the year, but it's too early to provide a definite forecast. We're keeping an eye on economic indicators and market conditions, such as interest rates and job numbers, as they evolve. Wolfe Research analyst Truman Patterson inquired, could you provide an update on the cost savings we can expect to see in Q4? Stuart Miller replied, I believe our relationships with our trade partners have enabled us to maximize performance, and consistency and predictability in terms of volume has been beneficial for all involved. Moving forward, the trajectory looks positive, however, we'll have to wait and see how it plays out. Zelman & Associates analyst Alan Radner inquired, Stuart, could you tell us more about how AI is impacting your business and what steps the company has taken to stay ahead of the curve? Stuart Miller replied, Alan, our machine-driven approach to the components of our business is data-driven. This includes digital marketing, dynamic pricing, and other processes that are reliant on feedback loops. We've made significant progress in this area over the years, and recently brought on board a strategic chief technology officer to further enhance our ingestion of data and maximize its use for productivity gains. If you're in Miami, we'd be glad to show you what we mean. We have visualized it so you can easily understand. Zelman & Associates analyst Alan Radner inquired, what is your view on pricing power in the current market and how it might affect demand? Stuart Miller replied, the great question you ask speaks to the need for more affordable housing across the country. We recognize the importance of this, and we've been very thoughtful in how we approach it. We focus on providing consistent and predictable pace, rather than driving up prices. This helps us rationalize costs while still providing the volume of supply needed to fill the void. Our executive team is committed to this strategy and discuss it regularly. Rick Beckwith replied, Stuart's response was spot on. We remain focused on delivering consistent, affordable starts and sales. We partner with our mortgage company, Lennar Mortgage, to ensure the right mortgage payment structure for each transaction. Prices may fluctuate, but we have targeted specific numbers of homes for delivery, community by community. John Jaffe replied, Our core strategy is production first. We prioritize production to maximize returns and cash flow, rather than limiting production and pushing pricing to increase margins. This consistency has enabled us to become a much more reliable company. Our pricing reflects this strategic decision. J.P. Morgan Chase & Company analyst Mike Rehout inquired, Do you feel that your approach to starts is resulting in market share gains relative to what you're seeing across the broader marketplace? Stuart Miller replied, The market's current appetite for ready-to-go inventory, coupled with the constraints of existing home market suppliers and the pullback from builders due to rising interest rates, has created an opportunity for us to fill a void. We believe that by providing what the market wants, we can increase our market share in the third quarter. John Jaffe replied, Stuart, I think it's important to note that we have an advantage over the resale market due to our ability to buy down mortgage rates. This gives us a lever to increase the pace of our sales should the market not be providing enough demand on its own. J.P. Morgan Chase & Company analyst Mike Rehout inquired, What percentage of total sales are incentives and discounts currently at compared to a quarter ago, and what is the trend you are expecting going forward? Diane Bissett replied, In Q1, incentives were 10.2%, which declined to 8.4% in Q2. This decline is tied to making homes more affordable for customers, and it's a lever we'll be using throughout the year. We haven't given guidance, but we've seen a downward trend from Q1 to Q2. Stuart Miller replied, Thank you for your insightful questions, Mike. We are very proud of how our business is performing despite the challenges the market has presented us with. We look forward to sharing in our third quarter report more information on our progress. Thank you for taking the time to join us.